The key to fitness is progression, but Xponential Fitness seems stuck in a flawed routine. Like any fitness company, it sells the idea of strength and stability, but behind the scenes, it's built on a broken foundation. Chapman University initiates coverage on Xponential Fitness, issuing a sell recommendation based on a 12-month price target of $10, representing a 42% downside from the closing price of $17.33 last Friday. Our sell recommendation is predicated on 4 pillars: a poor business model and misalignment with its franchisees, untenable competitive positioning weighing on Xponential, abysmal ESG with legal bouts looming, and no financial flexibility to support its long-term goals. Xponential Fitness is the largest franchisor of boutique fitness studios in the United States with a portfolio of 8 distinct brands. Franchise locations are mainly in North America, with a smaller international footprint concentrated in Australia and Japan. To better understand the importance of franchisees to Xponential's business model, let's run through it. Xponential retains the intellectual property of its brands, which it licenses to franchisees. They are then responsible for developing, marketing, and operating the studios. Customers can choose membership tiers, allowing 4, 8, or unlimited monthly visits, with few brands also offering multi-location membership tiers, but there are no cross-brand offerings. Xponential then takes general and marketing royalties from franchisees' gross monthly sales. Overall, franchisees contribute 91% of total revenue, driven by royalties and equipment, merchandise, and training packages connected to studio openings. License revenue amortization also fuels sales. Franchisees who choose to purchase more than one license are given a discount and schedule. If franchisees miss development deadlines, their license revenue is amortized immediately, creating an unsustainable source of revenue for Xponential. Poor studio placement is a byproduct of management's deleterious incentives to oversell licenses. Our proprietary analysis showed studios placed nearly on top of each other in key markets such as California and New York. The result? Franchisees receive less than 50% of Xponential's promised population. Xponential's motives are clear and detrimental to its franchisees, who experience sales cannibalization and market oversaturation as a result. Now, to Roya for industry analysis.
Thank you, Brady. Xponential operates premium studios in the highly competitive boutique fitness industry, where players offer unique experiences in small class formats. Xponential claims its total addressable market is $24 billion. However, our analysis demonstrates its TAM is 33% smaller, providing a 10% market share. But Xponential's ability to further penetrate the market is weakened by its poor competitive positioning. Xponential's appeal to both customers and franchisees is lacking. Its studios offer no industry standard amenities, yet Xponential charges higher membership fees, failing to justify its premium and pushing customers towards competitors. For franchisees, our capital efficiency multiple reveals a major barrier. Xponential's multiple is 27% higher than its competitors, making it significantly more costly for potential franchisees to invest. Moreover, though Xponential touts its ability to cross-sell memberships between brands, our survey, taken across 3 metro areas, reveals that only 10% of members access this, demonstrating Xponential's failure to create synergies for franchisees. Xponential's ESG performance is also concerning. It has never released a sustainability report, and its most touted environmental effort, installing water fountains in studios, falls drastically short of industry standards. Socially, Xponential also falls short. Externally, its meager efforts are limited to a one-time fundraising initiative of $200,000. While internally, Xponential undermines the values of its core demographic. This is seen in a 2022 sexual harassment lawsuit that alleged incredible allegations against a senior executive, followed by Xponential promoting the accused to president of Rumble Boxing after an out-of-court settlement. Poor governance further compounds concerns. The CEO's compensation is above 50% cash instead of performance-based incentives. There's less than 15% diversity across leadership, and 86% executives have a tenure less than 2 years. Weak leadership has resulted in multi-million-dollar settlements. And based on prior case fact patterns, we forecast Xponential's pending class action will be certified, resulting in financial damages that exceed prior expenses, making now the time to sell. Now to Gonzalo for financials.
Thanks, Roya. Despite having the worst profit margins in the industry, analysts are estimating a lucrative turnaround. But our analysis presents a different picture, one where profitability remains out of reach due to Xponential's poor franchise model, declining new studio openings, growing balance sheet constraints, and an unsustainable cost structure informing our EPS forecast. Xponential's success heavily relies on the economic health of its franchisees. However, our unit economic analysis has found that on average, 3 portfolio brands are unprofitable, while other 2 barely break even and only 1 meets the advertised margin targets between 25 and 30%. A key challenge that we identified is that franchisees are excessively charged for equipment, with Xponential inflating costs up to 33% for equipment-heavy brands and 18% for equipment-light ones, limiting franchisees' profitability. This issue, combined with market oversaturation, weakens unit economics, leading to a forecasted decline in same-store sales and a stagnation of average unit volume over the forecasted period. Consequently, licenses sold have sharply declined in the past 2 years, reflecting a weaker demand for Xponential offerings. This has translated into a fewer number of studio openings, a trend that we forecast to continue as the company's most successful brands are approaching maturity. We also forecast net studio openings to keep shrinking even further, after the latest debt amendment has enabled the company to start closing defaulting locations. As a result, with the applied franchisee economics and a forecasted decline in studio openings, revenue growth is set to slow down dramatically. After rising 34% in 2023, growth dwindled to just 9% in 2024. We forecast these issues to persist as closures increase and 2 brands are divested, limiting Xponential's primary growth driver, which has been inorganic expansion through the opening of new studios. Meanwhile, cost pressures remain a major headwind. SG&A represents a staggering 52% of revenue, meaning that is not going to be changed in the future due to ongoing management hirings. Aggressive spending in SG&A has failed to deliver material results, further eroding margins. Due to elevated interest rates and limited refinancing options, the alarming coverage ratios signal severe financial risk ahead, and past divestitures with no consideration at all have failed to alleviate discussions, indicating that selling off struggling brands like CycleBar or Rumble are unlikely to fix the problem. But this is particularly relevant because Xponential is drowning on $347 million in debt, with $46 million in annual interest expenses, eliminating any type of path to profitability. Even with our forecasted cash sweep, $297 million will still remain outstanding by the time the loan matures in 2026, posing significant refinancing risks. Weak free cash flow generation makes these challenges even harder, resulting in limited financial flexibility. And while the market continues to price in strong growth, profitability and shareholder return seem increasingly unlikely, signaling it's time to sell, not to tie for valuation.
Thanks, Gonzalo. Due to Xponential's negative return on equity, return on invested capital, and lack of dividends, the residual income, market value added, and dividend discount models were omitted from our valuation. Our model consists of 2 discounted cash flow approaches and a relative analysis comprised of a public comps approach. The final blended valuation yielded a target price of $10, a 42% downside from the closing price last Friday. The 2 DCFs included the terminal growth rate and EBITDA exit multiple approaches. The terminal values were assigned a growth rate in perpetuity of 2.5%, justified by long-term GDP growth, and an exit multiple of 16 times EBITDA, in line with industry average figures. Each DCF was weighed at 35% of the model, using a WACC of 10.3% as the discount rate. To assess the robustness of the DCFs, WACC was sensitized against the terminal value variables, which revealed minimal avenues for upside and shows that insufficient free cash flow will be generated over the forecast and horizon periods to intrinsically justify price appreciation. To complement the DCFs, comps were used to value Xponential relative to the market. Although all the companies in the peer set operate in the health and wellness industry, there are limited publicly traded players in this space, meaning franchised, corporate-owned, luxury, and budget-friendly business models are all present. Due to these discrepancies, comps were weighed at 30% of the model. Some risks to the upside are present and should be addressed. Xponential's experienced new CEO, near-term brand success of Club Pilates, rising consumer expenditures, and prevalent industry M&A all present risks to our recommendation. However, given the lack of CEO experience managing a portfolio of franchise brands, ongoing franchisee sales cannibalization, and our aforementioned thesis points, we believe these risks are unlikely to present a material impact. Therefore, Chapman reiterates its sell recommendation and $10 target price, representing all pain and no gain for investors. Thank you.
Oh, right on time, man. 2 seconds. Okay, guys, Q&A starts whenever the first judge asks their question. These 4 are judges. I am not a judge.
Okay.
What's WAC? I know weighted average coupon, but what's the second C?
Weighted average cost of capital.
Thank you.
Can you tell me a little bit about how you kind of analyzed just the general fitness world and the trends? Because you've got a rise in GLP-1s and maybe people aren't feeling like they have to work out as much, or, you know, is that kind of filtering into some of the analysis, or is it just really the execution that this company has kind of gone through that you're feeling negative toward? Does that make sense? I'm just kind of
Yes.
wondering, okay.
Do you want to go to TAM?
Yeah. In the core deck.
Yes. So we looked, and Xponential defines its target market as the population, education, and income level, and we boiled down all of theirs to determine that their total addressable market is smaller. In terms of addressing industry factors like the rise of GLP-1 drugs, that wasn't a part of our analysis. More so what we looked at was the prevalence of substitute goods, such as online fitness content, which is way cheaper than Xponential's offerings, and then commercial gyms, which offer more amenities, such as food and beverage, a place to shower, and not limiting consumers in terms of the amount of times that they can work out.
Do you have a sense to how, or what like the average tenure is for a specific location? Like how quickly are things, or are gyms opening up and closing? Just curious. Is there a lot of turnover?
You're saying about, sorry, I can re-ask you a question. You're saying about like how, if the studios open and close, like
How long
will
are
it last?
studios open? I'd just be curious.
So yeah, can you go to
On average.
appendix and go to the studio closures, studio opening forecast?
Right here.
Yeah. So one of the major challenges that we had identifying past trends was that Xponential was not able to close studios, or saying was the studio was closing because of one of the debt amendments. And also one of the things that has happened in the past is that Xponential has been buying studios back for only $1 because they were failing, and they will taking it back again. So the actual timeline we cannot estimate it, but we have seen that this trend is going to continue to increase since now they actually have to report and they're able to do it.
Additionally, there is a lag period when we see on the financial statements that studios closed,
Yeah.
because Xponential does not recognize studios as closed until they have not realized sales for 9 consecutive months. So it is that lag period that we are seeing taking effect.
Thank you.
Compared to their competition, the lack of amenities, does that improve their margins or hurt their margins?
The lack of amenities, well, may we go to, yes, please. So it is true that that would require more of an expense on the franchisee's end to supply these amenities. However, from an Xponential point of view, if they provided these amenities, they could actually charge franchisees a higher expense in their startup costs in order for this to take place. So it has hurt their margins because it's reduced the amount of revenue that they could be taking from franchisees.
Also, to add on a little more into that, for a franchisee perspective, it will be nice to have ancillary revenues, like, I don't know, selling drinks, selling food, but these studios are failing to do that, also putting a strain on the bottom line of the franchisees.
Could you? Oh, go ahead. Sorry.
Could you talk about how long it takes for a franchise to become profitable? What is the, you talked a lot about SG&A being expensive, and how does that compare with others in the industry?
Yes, so for the 2 questions, first, can we tie, let's go to the SG&A comparison.
In the appendix.
Yes. So as we can see, the SG&A is extremely elevated, and it has been because of incredible amounts of compensations for the board. That is kind of not justified for the amount of growth that they have been having in the past few years. So that is putting a lot of pressure in the company's bottom line, and it's even further eroding any type of profitability that they were able to have. And the first question was,
How long does it take for a franchise to be profitable?
so
We cannot provide a precise answer to that because the way that we conducted our unit
Approximate is fine.
Still, approximately, the way that we conducted it is a snapshot of the financial disclosure documents that's showing that over that 1 year period, what was the revenue generated and what was the profit levels generated that we calculated. And so what we saw is over that 1 year, from the middle of 2023 to the middle of 2024, there were 3 average unprofitable brands and 2 that were barely breaking even.
Yeah, to add on to that, I would say with regards to how long it takes, the company advertises a 2-year timeline to get to the 25 to 30% advertised operating margin, and it should be noted that this is operating margin. This isn't taking into account potential taxes or interest expense on potential leverage that franchisees would have to take out to fund the opening of the studio.
And what is the industry average?
We don't have a sense of industry average for competitors' unit profitability.
Then how can you make a sell recommendation?
We're making the sell recommendation because Xponential advertises these operating margins and profit levels to their franchisees. However, they're falling short drastically. They're falling short in a way where 3 are completely unprofitable and 2 are hardly breaking even. Only 1 meets operating profit margins, yet they continue to sell a false promise to franchisees.
Can we go to market oversaturation?
Yeah. In Quebec?
No, it's a.
So those bars, I'm confused, is that for Xponential or is that for the franchisees?
For the unprofitability,
Yeah.
it's for the
For
franchisees.
the franchisees, yeah.
Oh, okay.
Yes.
So Xponential's still making money on that?
Exponential does collect royalty and marketing fees off the top line.
Go to key state level oversaturation.
A3, please. Additionally, part of our sell recommendation is rooted in how Xponential's strategy for pitching franchisees is really unsustainable. They're focused on overselling in these key markets, which are already oversaturated. The size of the dot indicates the number of studios in zip codes, and the color indicates the population per studio. So what we found is that they're putting studios nearly on top of each other, and they're doing so in the same concentrated areas, which is bad for franchisees' economics, and they're already unprofitable. And further, management intends that this is their growth strategy going forward, not that it's going to start to have more consideration for its franchisees and have a more sustainable expansion.
Do you know what percentage of total revenues are actually coming from like when a franchisee opens versus like the trailing revenues that the company is getting from that? Because my question would be if they just continue to get people to continue to open up more and more franchises and they're collecting revenue from that, it seems like that might be good for Xponential. Not good for the franchisee, I get, but potentially good for the company.
Absolutely, yeah. Our analysis demonstrates that these short-term incentives to oversell licenses are actually detrimental in the long term, and that's demonstrated if we go to our net studio openings forecast. That studio openings, which is a strong driver of revenue growth, is going to decelerate and turn negative in the first forecasted year before slowly returning to net positive openings later on in the forecast.
To add to that, can you go to revenue segmentation in the core deck? In the bottom, you'll see the revenue that is as a result of studio licenses that are sold and never converted into open studios. They get to recognize that revenue on a straight line basis as opposed to amortizing it over a 10-year license period. And so they have a direct incentive to oversell these licenses. And what we're finding is that $20 million, assuming the minimum discount rate on licenses for bulk buying them, corresponds to 200 studios per year that will never open, never generate equipment, merchandise, or training packages connected to openings, or any royalties. It's a one-time, and because of the way that it's disclosed, it's baked into franchise revenue, which makes it look characteristic of future growth opportunities, which it is definitely not.
You talked about different brands that they have. If you were to say, okay, this brand is perhaps, you know, would be a buy, which would it be, and why?
So yeah, Ty, can you go to the core deck and go to the other one? So the only successful brand that they're trying to push and grow as much as possible is Club Pilates. So if there's only one brand that we're suggesting that it could be a potential buy or the shining brand of the portfolio, is definitely Club Pilates, because it's hitting their margin targets and it's hitting the AUV that the studios that the company is forecasting. However, management strategy is to start placing more locations in high areas where there's a lot of like top studios, and they want to start driving those AUV lower for franchisees, making it start to lose revenue sources as well for other franchisees.
Furthermore, from a company perspective, if we look, excuse me. Yeah, go to conflict of interest, present, it's not working.
Does it not work when you click present?
Yeah. If we go to, there's an inherent corporate governance conflict at the board level. The chairman of the board, Mark Grabowski, holds a direct ownership in
That's time, guys. Thank you.
Amidst the largest national increase in health and wellness in the United States, Xponential continues to underperform, despite favorable market conditions. And as a result, we recommend a sell recommendation with a $13.10 price target, signaling a 29% downside. Utilizing a comprehensive valuation and our three key catalysts: an inability to generate income in existing franchises, a strained franchisee relationship and an agency issue existing between Xponential management and their franchise business plan, and a lack of proven success with mergers and acquisitions leading to negative return on invested capital. Our research is predicated on our financial analysis, sustainability ESG in-house valuation, intrinsic valuation, relative valuation, and a 12-month Monte Carlo simulation, our industry positioning with respect to both private and public competition, and qualitative data extracted from our industry expert interviews. So first, we sat down with XPOF CFO John Maloon, their head of business development M&A Andre Mihich. We had a Q&A with a local cycle bar franchisee and its customers, and we consulted online discussion boards such as Reddit and Quora.
Xponential Fitness is a leading global franchisor of boutique fitness, overseeing a portfolio of 9 distinct brands, including Club Pilates and Stretch Lab. Founded in 2017 by former CEO Anthony Giesler, the company underwent a corporate restructuring in 2021 to streamline operations and has been publicly traded ever since for over 3 years. Xponential's franchise model is heavily dependent on one-time, non-recurring franchise fees. These fees include upfront costs paid by new franchisees to open a studio. While this fuels initial growth, it also presents a risk as future revenue depends on continued franchise expansion. Another key revenue driver is equipment and merchandise sales. Franchisees are required to purchase branded equipment directly from Xponential, creating a built-in demand cycle. Xponential, however, does its franchisees no service as they sell exercise bikes to them at an over 60% markup compared to a Peloton. Rather than supporting franchisee profitability, this pricing structure creates additional financial strain for operators, citing long-term concerns for profitability.
The fitness industry is set to profit from the economic influence of women, as they contribute 37% of global GDP, as well as more than 80% of purchasing decisions. With Xponential's consumers being 90% women, they're expected to profit from the growing discretionary spending forecasted to be 75% by 2028. As consumers enter 2025 with a focus on fitness, we see a lot of trends on the rise in health and wellness, including fitness boutique studios as well as online fitness classes. We expect these trends to stay on the rise as the industry is forecasted to double its revenue to $435 billion by 2028. Every year we see a predictable cycle. Memberships spike in January, only to drop off weeks later. Research shows that 50% of people quit their fitness goals within the first 6 weeks, and more than 90% cancel their memberships within 3 months. This phenomenon is known as the New Year's resolution drop-off. As you can see, the search terms gyms near me, as well as 75 Hard, which is a viral fitness trend, peak around New Year's only to drop off sharply later. Xponential is not immune to this, as they are class-based memberships, and thus retention will be a challenge. The biggest disruption in health and wellness have been GLP-1 prescriptions. By 2030, almost 30 million Americans could be using solutions as Wegovy or Ozempic. Competitors like Equinox and Lifetime have already jumped on this market by introducing GLP-1 programs. Xponential, however, missed the mark with Lindora's acquisition, which is a weight loss clinic, when GLP-1 users need strength training and not weight loss support. Since its IPO in 2021 at $12 a share, Xponential has seen a lot of volatility in its performance, seeing an all-time high of $33 around April of 2023, only to plummet due to a short seller report highlighting franchise struggles as well as lack of financial transparency. We also see it when Giesler was removed as CEO. So although economic and industry conditions remain favorable, we maintain a sell recommendation for Xponential due to company-specific risks, valuation concerns, and price performance volatility.
And now looking at our first catalyst, we see an inability to generate income in its existing franchises as a risk moving forward. Xponential's revenue has halted on the decrease in demand for new franchises. A recent class action lawsuit pointed out that 7 out of 9 brands in the Xponential portfolio are losing money. Furthermore, 60% of those revenues come from one-time starting fees, showcasing a 40% year-over-year retention rate. In regard to that, competitors such as Planet Fitness and Lifetime have a 90% retention rate, strong bolstering revenues, and an increase in demand for new franchises. On the contrary, Xponential has unethical conduct in their class action lawsuit, highlighting that they took unqualified franchisees to take out loans to meet their already lackluster franchise financial obligations for a new franchise, calling into question the ethical model of Xponential business plan. And then we see an agency issue taking place. It's clear to us that Xponential is emboldened to open new franchises, not focus on current franchise health. They make 80% of their revenue in upfront financing fees and equipment markup. As well, and then for franchises, we see that the best option to move forward is to separate from Xponential. This is already happening as 2 of the oldest holdings in the Xponential portfolio, Club Pilates and Cycle Bar, are beginning to terminate or renegotiate contracts moving forward, calling into question the sustainability of Xponential's business model.
A core aspect of Xponential's business model are their mergers and acquisitions. However, our analysis indicates that this is actually a weak point for the company, as they've had to fully divest from Rojas and Stride at a loss, and 3 more of their brands are at risk of divestiture per our conversation with upper management. Public competitors, Lifetime and Planet Fitness, display a positive return on invested capital, while Xponential displays a concerning negative 15% over the last 5 years.
ESG plays a critical role in long-term success. As you see, the board has undergone massive changes over the past years due to high executive turnover. The new CEO, Mark King, has a 68% compensation structure with targeted stock price units. So the new board also is facing an intense legal challenge with over 5 legal conflicts with the SEC, FTC, and state regulatory agencies. This is posing a big concern for their SG&A expenses and also public. Despite 3,000 studios worldwide, there's been 1,000 franchisee terminations, and this is reducing conflict or reducing. We also have our own ESG analysis, and XPOF is underperformed in all metrics of ESG.
Right. We've chosen not to place a discount on ESG in our valuation of the company, but instead use relative and intrinsic methods. For our relative valuation, we use an enterprise value over EBITDA comparable multiples analysis, and we recognize that Xponential's multiples at a discount compared to peers. However, we place this with lower weight to the unique challenges that Xponential faces in the business model and the difference in scale compared to competitors. For an intrinsic method, we use the discounted cash flow model as we believe this is best suited to evaluate the company. A deeper look into our financial analysis, we utilized a 7.1% compound annual growth rate. The company's high expenses, debt, and cost of capital at 11.5% overall contribute to our intrinsic share price of $10 per share. With this blended model, we utilized a 10,000 iteration Monte Carlo simulation to give us a 12-month forward price range with an 80% confidence interval from $10 to $22, and we place our blended price target within this range at $13.10 per share, with a 29% downside from today's market closing price.
2 key risks threaten Xponential's long-term growth: strained franchisee relations and volatility in changing economic conditions. First, franchisee relations are deteriorating. As 10-year leases are set to expire, franchisees are set to walk away and not renew their contracts, citing ongoing unprofitability. Second, even in a strong economic environment that favors this industry as well as the broader consumer discretionary sector, Xponential still lags in performance compared to its peers. So with these risks in mind, Xponential's long-term outlook remains highly uncertain. And so with that, we'd like to reiterate our sell recommendation. We'd like to thank you all for your time, and we'd like to open up the floor for any questions. Thank you.
Nice job, guys. Good early.
Thank you.
Did you say early?
Hold on one sec. Okay, you guys are good. Questions start whenever the first judge goes.
Okay, I have some questions.
I love them.
Yeah, of course. Can you go back to page 22? I just want to get a handle on give me some rationale between going from that 27 CAGR to 7.1, and also kind of think about they're obviously in expansion mode. They've taken on a tremendous amount of debt, if I'm not mistaken. So kind of what are they trying to achieve?
So I'll answer the business model question and he'll answer the valuation portion of this question. For the business model, on the 2024 Q3 earnings call, Mark King the new CEO, stated that they weren't prepared for the rapid expansion taken in the 27.4% CAGR, and they're going to focus not on opening new franchises, but trying to ensure profitability for their existing franchises. And so that's why we see that, as we see in the agency issue, their revenues are tied to opening new franchises. And until they can figure out a way to properly create stream revenues with their existing franchises, we don't see this as a benefit for them moving forward. So that's part of the business model that we see as 7.1% CAGR, and then Enzo can answer the valuation point.
Yeah, so they're not a data-driven company yet, and they're expected to raise operating expenses a lot for consulting and getting data warehousing and infrastructure changes. So we utilize a lower growth rate going forward because the company is recent. So they went public in 2021, and they've only existed since 2017. So since their growth, they've obviously expanded a lot. 2021, they're coming out of COVID, gyms were closed, and a lot of new studios were able to open after that. As fitness became, everyone wanted to start hitting the gyms again. COVID, bad years for everyone. So there was a big growth for those years. However, in 2024, their growth actually tapered off. The company highlighted that their revenue to close the year could be anywhere from $310 million to $320 million, which is a 2%, negative 2% growth, or 0.5% of growth. So the revenues definitely kind of went stagnant as studio openings have slowed down, and they're more dependent on expanding revenues that are already existent, which is to kind of go off the franchisee. We utilize a few different opinions about boutique fitness from firms like Berkshire Hathaway to overall come up with our compound annual growth rate, and 7.1 is a pretty solid estimate going forward for the next 5 years.
Okay. Can you talk a little bit more about the debt that they're taking on, and is it that they're really just focusing on profitability with their existing franchisees? Is that the path?
Per our conversation with the CFO, he highlighted that they don't have a fixed rate debt instrument. So when rates were low, they took on floating rate debt. And so as you can see in the investment risk slide, we have changing economic conditions as a huge risk for Xponential moving forward, because we believe that if rates don't come down, this will only increase their debt and affect their profitability moving forward. So that's why we believe that another thing for the compound annual growth rate, how that affects economic conditions. And there's no clear, the Fed has not signaled clearly how they're going to change rates in the next couple of years.
Yeah, and with interest rates that may continue to rise, it might slow down the interest of people opening franchises. A lot of the franchisees are upper middle class, and they've actually been encouraged to take out small business loans by management in the past. So with shaky interest rates, people may not be encouraged to take out loans, go into this venture, especially when profitability is anything but promised.
So with the new management team coming in, what would you say is maybe the biggest risk to your thesis? What can they do that would potentially change or increase that 7% annual growth rate?
Well, I would say the biggest risk is the fact that they're all new and they're all in different industries, such as Taco Bell as the new CEO, and that they're not, I guess, in the right.
They don't have a background in health and wellness.
Okay. But one of the biggest risks that we would see to our valuation is that we do believe that they are focusing on data warehousing. That was something reiterated by both the head of M&A and the CFO. However, we believe that they're very far behind in implementing this for effective. They're looking to hire a CMO now in order to properly data warehouse and market their franchises. But we believe that they grew too exponentially fast in the beginning, and that they are now going to have to recoup so many losses from failing franchises, and that they should have been doing this before their IPO. And it feels like this was a company that wasn't prepared to go public, and now it's already dealing with the short attack, and then we see the CEO removal. So we think that it's almost a case of too little too late, in the sense that the network is so wide, and we see then that the CFO is highlighting that they might divest from more brands such as Cycle Bar and Rumble, and they actually in their 2024 10Q and their 2023 10K, they highlight M&A as a strong suit, and we believe that's not the case. And so if they're not able to use data properly for investments moving forward, then we can't see a reason for this to affect our valuation.
Right, and one thing the management could do is they could clean up a lot of the legal issues. The CFO actually cited their legal problems in battle with the different regulatory agency probes as something that's really driving up their SG&A expenses, which overall lowers their free cash flow. So if the new management could clean that up, that could lower expenses going on in the future. But expenses are continuing to climb with the new consulting and infrastructure changes that they might need. So.
Thank you.
2 questions. First, what's their debt to EBITDA, or what's their interest coverage ratios?
Yeah, I believe I have this. Yeah, so their EBITDA to interest multiple is we projected it to be 2.2x for this closing year of 2024. And sorry, what was the other metric you were asking about?
It was really debt coverage, or EBITDA to debt.
Yeah, and about their capital weight. So they actually have, from their balance sheet, they have negative equity in the company from having negative 600 million in retained earnings. This is so the company's in no position to offer dividends or anything of that sort, as they don't have the profit.
So then that leads to my second question. Since the IPO, have they issued any more shares since the IPO?
Since the IPO, yeah, they have. And there's actually a lot of insider selling. I don't know if you're curious about some of that, but in 2024, we noticed that, excuse me, go back to this slide quickly. Yeah, so we noticed that the company is mostly insider selling. They did $4 million, or 4 million shares sold this year from directors, upper management, and they only bought 800,000, so that's a bit of a concern to us.
Thanks.
Yeah.
You talked about some of the question and answer you had with the CFO, and you also mentioned in your slide that you talked to the VP of Business Development, but you also mentioned that you did primary research perhaps with customers and franchisees.
Yes.
How did those views align, and how did that shape your presentation? And were there any surprises?
There was a very large surprise in that the CFO and head of business development focused highly on their playbook as a positive, and the things they do for franchisees is a huge plus in moving forward for their growth strategies. And when we spoke with our local cycle bar franchisor, she said that they got almost no help from Xponential in opening their franchise, and they felt extremely overworked during the first 2 years of their opening. And they believe that one of the issues, systemic issues, is that whereas a big box gym such as Planet Fitness or Lifetime, you hire a general manager and you have equipment sitting there and you don't need to fully instruct, boutique fitness is fully service-based. So you're expecting these cycling or Pilates, any of these instructors to not only run the classes but also run the marketing, run their finances of their business, and keep it profitable, and it's just not sustainable. So that's one of the things that we learned from our individual research is that the mission of management and the actual reality that is opening a franchise is entirely different.
What about customers? Follow up to that. What did you hear from customers?
Well, for customers, we found that a lot of them were very alarmed. For one, they didn't know what Xponential was. That was the first thing that was very alarming to us, is that in order to be profitable as a public company, you do need to have some exposure, and if your main clientele doesn't actually know who the parent company is, they wouldn't be able to even know how to invest in, let's say you believe in Cycle Bar or Rumble, you don't actually have an ability to invest in the company because you don't even know that Xponential is the holding company. And the second thing we found is that when we brought to light some of the accusations and lawsuits going forward, they were actually appalled to find out that the company that's holding their Cycle Bar, because they have a lot of love for their individual instructor who runs their own private business, but they didn't know that a large corporation actually is siphoning profits from them and adding no real value to the company.
And very quickly, how did this impact your presentation or your decision?
It gratefully impacted our presentation because there's so many alternatives. There's so many private and public alternatives in this low barrier for entry space. We see every day the Method is a very large local Pilates place that's they have 20 studios just in the Orange County area, and then you also have privately held companies such as Bar Method or Club Studio, which is a privately held but widespread chain of Pilates. So when there's so many alternatives and there's so many issues with management, we see that there's also there's a huge risk there. Also, a lot of clients or customers claim that since the acquisition from Xponential, the quality of classes has gone down a lot because they look to vertically integrate and synergy between their two product offerings, and so they cut costs by lacking diversification in classes.
That's time.
Thank you.
Thank you.
Okay.
Community engagement, dominant market position, accessible wellness.
Today, we issue a buy recommendation on Xponential Fitness based on a 1-year price target of $21.1 based on a DCF and supported by a relative valuation, presenting a blended upside of 22.2% from the closing price of $17.3 on the 12th of February 2025.
Our recommendation is backed by a strong competitive positioning, an uncontested business model, and a scalable asset-light franchising model.
Xponential Fitness is the largest global franchisor of boutique fitness brand, operating with a diverse portfolio of 8 different concepts across 3,100 plus locations in 49 states and 28 countries. Xponential is very asset-light model because mostly they focus on licensing and supporting their franchise with resources. Xponential streamlines its revenue to 3 main sources, 45% of it coming from franchising, 17.5% coming from equipment sale, and services like X Plus and X Plus generating the 18% of revenue.
The boutique fitness industry has shown remarkable resilience and growth, expanding from $43 billion in 2023 to $47 billion in 2024, with a projected compounded annual growth rate of 8.23% and the market anticipated to reach $75.04 billion by 2030. Based on our survey, we expect a steady demand in the future. Moreover, more than half of the participants are willing to attend these classes for the next 10 plus years, which we believe Xponential will capitalize upon. Despite the pandemic closing 19% of US boutique studios, Xponential Fitness has expanded their business through franchisees, diversified business offerings, and attracting mid to high level income consumers with community-driven experiences.
Now, Xponential Fitness is, at its core, an exceptionally well-positioned business. Their competitive positioning stems from Xponential facing virtually no direct competitors. And this is because Xponential Fitness is the only company that owns and franchises multiple boutique fitness brands under a single robust umbrella. Now, the only company that truly compares to Xponential's umbrella of offerings is Equinox. However, they differ in price and geographic accessibility. Xponential Fitness offers a more affordable and a more accessible alternative to Equinox, who charges up to $415 per month in only 110 locations, while Xponential offers studios in over 3,100 places all over Earth, making their structure difficult to replicate.
Boutique fitness is a stable and promising industry, highly valued by its consumers as seen in the survey. After we attended a Club Pilates session and surveyed 800 individuals, we gathered the instructors were kind, educated, and relatively emphasized the importance of Pilates. Our conversations gathered high-quality instructors, results-driven workout, variety of classes, as well as community-driven experiences, which sets the boutique fitness industry apart from other gyms like LA Fitness and 24-Hour Fitness, reinforcing market dominance and competitive positioning. Moreover, more than half of the participants stated that they would continue attending these classes for the next 10 plus years, indicating future financial stability and growth.
The critical drivers of our investment thesis include a diversified business model, strong projected financials, and the resilient growth of the boutique fitness industry. Due to its unique structure, we are unable to compare Xponential Fitness with direct competitors like Equinox or Singular Brands. However, historically, we've concluded that Xponential outperforms public industry peers like Technogym, Planet Fitness, and Lifetime Health Group with a 44% revenue CAGR from 2021 through 2023, far exceeding the industry average of 27%. Additionally, we project that Xponential's revenue will grow at a 20% CAGR for the next 10 years.
We also forecast an EBITDA margin increase from 18% in 2023 to 31% in 2026, driven by cost reduction synergies from strategic acquisitions of boutique fitness brands. Additionally, the PP&E accounted only for 3.7% of total assets, which is why Xponential operates with an asset-light, scalable, proven business model, enabling rapid expansion without the burden of high capital expenditures. Further, while the net income in 2023 was negative $1.7 million, it has significantly increased from negative $51.4 million in 2021. For that reason, we believe Xponential will improve its profitability with an incremental rate over the next years. Its current ratio of 1.05 ensures liquidity, and with its debt-to-equity ratio of 1.89, the expected growth will act as leverage, generating higher returns in the future. With this high margin franchising strategy, Xponential Fitness is well positioned for continuous expansion and long-term profitability.
The company continues to reduce its environmental footprint through innovative sustainability efforts like using NSF-certified floorings across their studios, having water replenishment stations, saving gallons of water every day, and by also offering organic products like 100% recyclable stretching mats. On the social front, the company demonstrates empowerment, displaying 71% women in the workforce. The company continues to fight cancer, teaming up with American Cancer Society, and supporting families through Miracle for Kids. Mark King, appointed as the new CEO in June 2024, brings an extensive experience from his previous leadership roles at Adidas and Taco Bell. Under his leadership, the company saw a 21% increase in system-wide sales. The new leadership positions the company to grow as a global franchisor for choice in fitness and wellness.
Now, as there is no significant environmental concern, we have chosen not to place a discount based on ESG in our valuation. And we have valued the business using both relative and intrinsic methods. Now, on a relative basis, we have weighted comps at 20% as they have no direct public competitors. However, our findings indicate that the most comparable companies trade at an average EBITDA multiple of 16x, while we expect Xponential to trade at an EBITDA multiple of 12x, suggesting a potential undervaluation. Now, looking at an intrinsic value and evaluation, we took a more aggressive approach, considering the boutique fitness industry's projected growth and also looking at Xponential's historical growth, assuming a 20% revenue CAGR from 24 to 2033. Now, across the relative basis, the exit multiple, and the terminal growth basis, assuming all dilutive securities are exercised in a fully diluted manner, we see a potential blended upside of 22.2%.
What are the key risks facing our confident valuation? We've identified 2 risks that we believe are worth addressing today. The first risk regards political dynamics. As a fluctuating political dynamic environment poses a market risk as an increase on tariffs as well as a change in corporate and franchise tax policies may impact Xponential's operations. However, Xponential operates with a unique Up-C tax structure, allowing it to pass its taxable income through members based on ownership, leaving Xponential only responsible for their 66.7% stake, overall lessening the financial burden. Further, the second risk regards their long-term debt. As of 2023, their long-term debt stood at $319 million, with plans to refinance or delay future capital expenditures if repayment becomes challenging. They continue to invest heavily in diversifying their portfolio while divesting from brands that underperform. This bets heavily on market trends and consumer preferences, yet reiterates our analysis that Xponential is exceptionally positioned to remain relevant in an ever-changing market, competing with a strategically different model than competitors. And further, their financial debt will increase financial leverage in the future.
The diversified portfolio of brands and strong brand identity will be the main strengths of Xponential, while the dependence on franchisees and certain macroeconomic challenges sensitivities may act as the weaknesses. By continuing to provide online classes, software apps, and partnerships, the company will be able to take the opportunity to increase its global reach further. However, the franchisee mismanagement and overdependence on the franchisee structures may act as the main threats. Despite that, considering all the factors, we believe right now is the best time to invest. Thank you for your time. Now we're open to answering any of your questions.
Because it's done early too. Nice job.
Thank you.
Good. Get that in your head.
Yes.
Okay.
Okay, judges, the time starts. Next 10 minutes when one of you asks a question.
So it looks like they've got a bunch of different brands. Love to buy them. Can you tell me about the different brands that they run and how profitable each one of them are?
So their main brand is Club Pilates. That is their where they gain their most revenue from. However, their brands include different fitness modalities such as Club Pilates, Pure Barre, which is a bar exercise, and then they've got Stretch Lab, Rumble, Lindora, which is their newest acquisition. It's a weight loss, and Stretch Lab, Club Pilates.
But are they all profitable?
So currently, the company is doing its best to ensure the profitability happens for all companies, but a lot of times what happens, they divest from the companies that are not profitable, end up being underperformers to increase their share in overperformers. So currently they're not all profitable, which is why the company hasn't seen high profits yet. But it's a new company, and as we said, the leverage that the company has is going to overly increase its profitability in the coming years.
Can you go to the revenue slide? So I just want to make sure I understand how they're making money. Yeah, it was actually that, that can work.
This one? Just one.
Yeah, that's fine. Yeah, this is fine. So if I want to do all of these different, modalities, am I paying a one-time fee to have access to all of their brands, or is each brand kind of individual from a consumer perspective? Like, what's my experience with them?
So from a consumer perspective, you would pay for the individual brand. However, they do offer XPass, which is an app on your phone, and it basically shows up with all of their different brands and classes that are being offered near you. And you can gain rewards by attending other classes, and you can win prizes. I think their top prize is actually a Porsche. So things like that will increase consumer demand over time as well, yeah.
Did you get a chance to kind of talk to any franchisees to kind of get their experience in working? Because you said that there's some that are profitable, some that aren't. I guess I'm just trying to understand, what's their end game? Because you made a comment that they have a dominant market share, that they're uncontested business model, but I mean, there's a lot of places to go get fitness these days. I mean, I get it on my Peloton every morning. So I guess I'm just trying to understand why you feel so strongly that they're in this, really unique space.
Thank you for the question. Mainly, the best factors about them is when we attended a session of Club Pilates in San Diego, we figured out that most of the people that come there are for their community experiences. They come there to engage with the community, coordination as they age overall. Secondly, as compared to other market leaders, as we saw, for example, let's take Equinox as an example. Their monthly subscription overall is approximately $415, which is sometimes not very economical to a normal, you could say, a middle class household, and this is much more economical, providing a wide range of brands within them as well. So, yeah.
Right. True, but you're kind of going to each one. It's not a one kind of you're not encapsulating all of them. You're kind of, if you just want to do the bar or you just want to do Pilates, you have to go to each of those specific brands. Is that correct?
Yes, that's correct. But so their portfolio is very diverse, which means if a consumer like you or me decides to go to one brand, they're profiting off of you. Yet if a consumer is deciding to go to another brand, they're also profiting off of them. And also they are ranked in the top 20 list as the first Google search when you type in top boutique fitness studios. Multiple of their brands are listed in the top 20 list.
Do you have a sense of, do you have a sense of how many franchises have opened up over the last few years?
Just to add to that, there's not specific information about that, but most we know that they have approximately 3,100 locations, and they're mostly in 18 countries. But overall, we're not certain about the amount of, we could say, franchises that they have overall last year.
And so does your buy recommendation, is there an assumption that they're going to continue to expand that at that rate, at that pace? Are they going to be able to do that, or they just went public and they took on a bunch of debt and they ramped up growth, and is that not sustainable? So just a question.
So actually, the way their structure works is they don't get those locations. They essentially get the franchisees to open up the locations, and they get the debt to buy the product, the brands.
Right.
So they basically chose the 8 brands they have currently, and they plan on buying more brands, and those brands either have already existing locations, or the existing 8 brands they own, they might have more franchisees opening up locations. So they do plan on getting more locations, but it's not going to cost any additional expense to them. The only reason they use the money for is to buy brands.
And to add on that, you asked if our recommendation is based on them opening up more studios, and yes, we believe that in the future they will open up more studios through strategic acquisitions and acquiring competing with other studios in all over the world. So yeah, it is also based on that, absolutely.
In addition, even add to that, they're even going through a phase of rapid expansion. They're trying to, diversify their portfolio as much as possible. So, yeah.
Is oversaturation a problem, where they have too many studios open within a few square miles of each other?
Yes, it's not a significant risk as we see it. We believe that market saturation will increase as they continue to grow and mature as a company. But as of right now, we don't see that as a major risk.
What is their annual recurring revenue as a percentage of their total revenue, and how does it compare with the industry? And how does it factor into your recommendation as well?
So their recurring revenue is at 72%, I believe, which is listed in their investor reports. So.
Yeah.
What's the
So
industry?
you mean like the growth rate 70%?
No, the recurring revenue.
We don't have a slide for that. We don't have a slide for that. It just basically came through their income statements.
So for 2023, we have here that the revenue is 318 million. And while the company hasn't been profitable yet, we have seen that it has been continuously expanding its revenue growth. And we estimate it's going to keep going over the next decade. And even though the growth rate might slow down due to market saturation, as you mentioned, this is still a new company. It's still growing, and we see a lot of potential in that.
No, this is not about the growth of revenue. It's about how much of the revenue is recurring versus non-recurring. What is that percentage?
Oh, so
how does it compare with the industry? And how does that factor into your recommendation?
Yeah, it's 72%. However, the industry is it's hard to talk about the industry because this is such a unique company in its structure. All the other competitors were not actual direct competitors. They're more so comparable companies. As we already mentioned, they don't have the same structure. Companies like Planet Fitness, they're meant for regular people who go to gym and pay a $10 a month subscription. Actually, they benefit from the fact people forget they have the subscription. While this is meant for people who are interested in specific boutique fitness practices, and they pay an extra fee for that. So it's hard to, I guess it's wrong to compare it directly with the industry.
So how many brands do they have, you said, within the holdings company?
8.
8. So, and you said they're going to expand it, buying other brands, and brands that don't make money, they divest, right?
Yes.
So do you think that's an issue, that their focus is just all over it? So from your experience or your analysis, do these companies cannibalize off each other?
No, I don't believe that I don't believe that these companies compete with one another, because, as I explained earlier, if I were a consumer wanting to attend one versus wanting to attend the other, both are profiting, creating the same franchise royalties that Xponential would receive, going straight to Xponential. So I don't believe that they would be competing with one another.
What is the average time for a franchise to become profitable with them?
Can you repeat the question?
Sure. How long does it take for a franchise to become profitable?
Okay, so I read their income statements, and because the data only shows that they went public in 2021, so their annual report only has data for 2020 and some of 2019, we see that when they're acquiring brands, their debt is always high. And because they're still in their transition phase, their revenue is of course not as much. But what we have noticed that from year 21 to year 22, as they stop acquiring brands, but instead of expanding them, they have more stable and fixed income, kind of like a fixed income source. And the same thing have been noticed in 2023 when they let go of one more brand called ATK, because they weren't generating enough revenue. That's why they left them. I think it was an annual report of 2022 or 23, and that's why I believe that once the franchising stays there for almost 2 to 3 years, and it establishes a good ground, they would start generating a stable income, and we can expect the growth.
That's time.
That's good.
Thank you.
Ladies and gentlemen, thank you for giving us the opportunity to come here and present to you today. My name is Richard. Today I'm going to be joined by Vincent, John, Aaron, and Jay. And today we're going to be discussing Xponential Fitness.
Xponential Fitness is a boutique franchisor of different brands such as Club Pilates, Yoga 6, BFT that offer specialized services such as Pilates, yoga, and indoor rowing. We're going to be pitching a buy thesis on the company today, and we have 3 main points. The first point is going to be we believe that the company is going to be able to grow their studio base globally, and then the latter 2 points are going to be we believe that the company is going to be able to expand their margins. Going over the business model of the company, we do see that they have an asset-light franchise model. Some of the benefits of this model that we can see from the graph on the left is that they offer 73% recurring revenue. Additionally, we believe that this franchise model allows them to have higher scalability and operational efficiencies. Some of the challenges that we see with the business, we do want to acknowledge that not all franchisee performance is going to be stellar. Additionally, we do see that the company has some outstanding litigation, so the company is going to needs to settle that in order to be successful in the future. And lastly, they're going to need to refinance their debt. With that being said, I'm going to pass it on to Aaron to talk about the company's competitive advantages.
Thanks, Richard. So Xponential is a boutique fitness franchisor, which differentiates them from your typical big box gyms like Planet Fitness, or even your luxury gyms like Lifetime Fitness. For starters, they cater to a much wealthier clientele, with their average consumer having twice the median household income. This allows them to charge the $135 a month average membership fee. And because these are smaller, more intimate experiences, they require a much smaller footprint, resulting in significantly smaller initial investment costs. Now, these smaller costs have led to faster studio growth, where they've seen a 20% CAGR in operating studios since 2021. Combine this with an average studio sales of $500,000 and a 90+% retention rate, and we see they've been able to scale top lines faster than competitors as well. So with that, I'm going to hand it over to Vincent to discuss the financials.
Thank you, Aaron. So looking into Xponential's historical financial performance, ever since 2021 IPO, we noticed that their revenues have grown significantly. This is primarily in part due to their studio expansion, both domestic and internationally, as well as their acquisition of name brands, most recently the brand Lindora, a weight loss drug aiming to help consumers with their weight loss journeys. We do notice a slight downtick in 2024, and that is primarily due to divestitures of underperforming brands, which is now offset by Q3 of 2024 and projected to increase with time. Moving down their financial statement, we notice that their margins take a significant dent when it comes to their operating expenses. Most notably, this is carried on by SG&A, which carries a large percentage of their revenue. SG&A is primarily driven up by their salaries, especially due to the company-owned transition studios, and as well as the restructuring plan that the company has started in 2023 to close said company-owned transition studios. Further down, we also notice a significant interest expense, which does dampen the company's margins. Now I'll be passing on to Aaron for our first thesis on our buy recommendation.
Thanks, Vincent. So Xponential's recent strong performance has led to aggressive domestic gains in market share, which is seen as in their market share has tripled since 2020. Now management is pivoting their focus overseas, where they've opened 235 locations since 2021, bringing this segment to 14% of their total studio base. This serves as management's solution to the problem of saturation within North American markets. Ultimately, they have a vision for this to become a core pillar of their business with a long-term goal of comprising 50% of total operations. This deliberate expansion will serve as the foundation for continued growth and diversification, reinforcing their position within the industry. And now I'll hand it over to Vincent to discuss our second thesis.
For our second thesis, we are looking into the company's debt standing. We notice that their long-term debt they have a significant long-term debt of $350 million, financed at an 11% interest rate. We spoke with management, and they told us that they are expecting to refinance that debt before the balloon payment in 2026 to a high single digit. We went with 9% for a more conservative approach. The company currently does stand at a good position to pay off their interest payments, but as I had mentioned, their balloon payment is cause for concern in March 2026. With the refinancing, they're aiming to lower their interest expense and improve profit margins and put themselves in a favorable leverage position to expand their company compared to their competitors. Now I'll be passing it on to Jay for our third thesis.
So our third and final investment thesis is heavily dependent upon Xponential's restructuring plan and its goal of achieving long-term profitability. So this restructuring plan is essentially a crucial pivot back into their pure franchise operations. As per our forecast, we're expecting a 10% decrease in SG&A expense as a percent of revenue from 24 to 25. With that said, the primary objectives of this restructuring plan is to exit company-owned transition studios while also enhancing their focus on successful and growing brands. This focus on their successful brands allows them to decrease the amount of contract terminations and also potentially decrease the amount, the chances of franchisees failing to perform obligations, thus reducing their expense even more. All of this restructuring plan all depends on the ability to terminate the lease obligations and as well as management's execution of the plan. So moving on to our intrinsic valuation, our main free cash flow to firm drivers are average revenue per studio as well as your studio growth. With this in mind, we are still taking a conservative view on our forecast for the company, adding a 1% litigation risk premium to our cost of equity, yielding a WACC of 9.5%. Finally, our SG&A expense as a percent of revenue is also lower than the street's average. We're forecasting a 34.8% average, whereas street is a 31.5%. With our relative valuation, we decided to use revenue multiples since Xponential Fitness is a relatively young company and has also had recent volatile earnings. In addition, we weighted our relative valuation at 20% since Xponential is an emerging growth company that participates in the boutique fitness industry, which differentiates them from peers. With that said, we assigned 4.5 and 2.7 EV to sales and price to sales base case multiples. When wrapping everything together, we have an implied share price of $20.95 a share, which is a target upside of 28% from our valuation date. Now I'll hand it over to John for our ESG and investment risk.
Thank you, Jay. Now for our ESG, we wanted to focus on Xponential Fitness's progress in these three segments. For environmental, they have implemented recyclable flooring tiles in many of their studios, including Pure Barra, which reduces plastic waste. For social, they have supported breast cancer research with the American Cancer Society and given back to many of their communities. And for their governance, they have introduced a new management team, including Mark King, the new CEO who was introduced this year, who we believe will be able to execute on their objectives. For investment risk, we do want to acknowledge that the company is currently experiencing litigation, though we accounted for this in our WACC with the 1% premium, and we do believe that will be enough to account for that. For the macroeconomic risk, this would be the risk that should there be another pandemic, the company would be forced to close their franchise stores. And finally, execution risk, which is the risk that the company would be unable to grow their studio base and improve their margins. Though with the recent strong performance of their stores, coupled with the new management team, we believe the company will be able to accomplish these objectives. Now I will pass it off to Richard to wrap it all up. Thank you for that, John. Now, under the new management's tenure, we do expect that the company is going to be able to successfully execute on their goal to expand their studio base. Additionally, we do think that the company is going to be able to refinance their debt at a more favorable rate, further expanding their margins. And as we see their restructuring plan come to a commencement, we do think that the one-time SG&A costs that they're currently incurring are going to be gone and they're going to be able to expand margins further. With that being said, we'd like to thank you for the time, and now we want to open the floor to Q&A.
Q&A starts whenever you guys start.
I'll jump in. Can you go back to the risk page and talk a little bit more about the litigation risk and kind of what's going on with their franchisees, these store closures? What's going on there?
Yeah, I'll take a stab at it. So what the company was accused of doing in 2024 was misrepresenting their store closures. So one of the things that we tried to evaluate was, let's say the company was found guilty of this. We try to look at similar small cap companies or similar companies that were found guilty of this to kind of estimate what the payment might be if they were found guilty. We weren't really able to find a comparable, so we wanted to add a margin of safety to our valuation by adding a 1% premium to our cost of equity.
Yeah, I get that. I guess I'm just trying to understand what they're actually being accused of. What does it actually mean? Are they Is this something that they're having an issue with their franchisees? Is it, one bad actor? Like, I don't understand what it is, I guess, that they're being sued for.
Yes, so I think it's a couple of their franchisees and even some investors. They're accusing the company of not correctly reporting the store closures.
Okay.
Question, if you could jump to page 4 for me. So just diving deeper into the reoccurring revenue of 73%. So the majority of that is coming from franchise royalty fees.
Yes, sir.
And this is in 2023, so in a period where they've had, pretty substantial increase in number of new franchises, franchise royalty fees would be high. Question for you, when a new franchise comes on, does the royalty payment, is there like a large upfront payment and then the annual royalties tick down over time, or is it the same exact payment every single year? Because that might impact how much is actually reoccurring versus how much is upfront.
Yes, so there's going to be within there, I think it's a smaller portion. So on this franchise territory fee of 9%, that's where they pay an initial payment to go into it. A franchisee would pay $45,000 or so to open up the store, and then that's not going to be included in the recurring. And then the royalty fees, that's going to be the recurring revenue that the company would expect to receive. That's at approximately 7% of their gross sales. If you could follow up.
Got it. Okay, so that's not just an inflated number because they've had more stores at this period of time.
Correct.
Okay.
What are the margins like on each of their business lines? Are they all profitable?
Yes, so I'll take a stab and I'll kind of open the floor to the rest of the team. From what I remember, I wasn't really able to kind of look at the different revenue streams, like the margins for each segment, just to be candid with you, but feel free to take a stab.
So the average across their whole portfolio of brands is about a 25% operating margin for these studios. Now, again, this is an average across all the brands. This includes underperformance that they're actively divesting from. In terms of specific brands, we could not find data alluding to the individual performance of that brand. We just know that the average is about 25%.
One of your theses, the first one I think you mentioned, is that they will expand internationally. How does profitability compare internationally versus domestically? And could you talk about how that impacts your recommendation?
Absolutely. So in our conversation with management, they did comment that their international studios perform very similar to their domestic ones. So we're looking at around $500,000 in annual revenue, as well as that 25% operating margin. Now, could you repeat the second part of that question? Sorry.
How did that impact your recommendations?
Right, and maybe Jay can speak more to this in terms of valuation. But we assumed similar performance to those domestic studios.
Yeah. So basically in the valuation model, we assume these international studios are going to reach full maturity and basically achieve that same amount of sales that a domestic studio may achieve as well.
You made a comment about interest rates on debt, and obviously they took on a bunch of debt as they're in growth mode, and we expect them to, I think, continue to be in growth mode. So what are the factors that are making you think that they're actually going to get to refinance at a lower interest rate relative to what they did they took out the debt in early 2020s. Why do you think they're going to have a lower interest rate? I just dig in a little bit more on that.
Yeah, so one of the things that we're seeing is that is their restructuring plan. So they're closing company-owned transition studios, which have lower margins. So as we see that those company-owned transition studios kind of goes below 1%, we expect them to realize more favorable margins since they don't have those studios within. So we believe going forward, their margins will be better, they'll have a better credit rating and be able to get a lower rate, therefore.
Does the impact on general rates in the economy going from where they were in 2020, 2021 being ultra low to where they are today offset that a little bit? Do you think it will? Or is it enough? Is that more than enough to offset the general rise in interest rates?
If I could take a stab at that, the rate that we're talking about is actually a floating rate. So you have your SOFR plus a spread of about 600. So the rate you're seeing right now is essentially we're predicting a reduction in the spread, not the initial SOFR level.
Okay.
Did you think about kind of industry trends as it relates to, you know, GLP-1s? You know, they've got the Lindora brand, but, you know, is that going to be something that's waning? Or are they going to, you know, jump on board? Like, how is that going to play out?
If I can take a stab at that, we don't believe that these GLP-1, medications will prove a substantial harm to Xponential Fitness's business model, since one of their main competitive advantage is this social aspect of it. People want to go to a gym, they want to meet people who are interested in doing the same exercise, and that's not necessarily something that's provided by medication per se, right? So if that answers your question.
Well, and I guess I would have you elaborate on their Lindora brand, because that's very specific to medications.
Mm-hmm. Yeah, so that acquisition of Lindora brand, if anyone wants to jump in, but...
Yeah, so I'm sure you're familiar, right, the Lindora brand, that use GLP-1s to help clients lose weight or manage their weight. So we do think that they have some exposure to some of the upside with those new drugs. What we do see, to try to reiterate, what we see from these brands, these are premium brands. We do think that there's the appeal to go to these brands. It's a premium service. So when people go to let's say Club Pilates, they can tell some of their friends, oh, I'm going to Club Pilates. And you're also kind of building that community of people who are also like health conscious.
You're talking about debt refinancing here, for example, but typically interest expenses are excluded, as you know, from EBITDA margins.
Mm-hmm.
So then what margins are you talking about here when you say further margin expansion? And then secondly, let's say they are not able to refinance the debt, how does that impact your recommendation?
So I'll take a stab at the first part of the question. So for the first part, we're talking about profit margin specifically. So in this chart, we're noticing this is actually their net income that we're forecasting into the future.
So coming from financing, you're saying the financing end will increase rather than the actual operations. So how is that a good thesis for a buy?
I'm so sorry, can you repeat the question?
Sure. So EBITDA margin, as you know, doesn't include interest.
Mm-hmm.
However, one of your thesis says that they'll expand their margins, but it's not the operating margin. So why is a financing element a part of a buy recommendation? Could you explain that reasoning, please?
Mm-hmm. If I may answer that, we think that debt refinancing is crucial for the company, since as of recently, their high interest expense has been weighing down on their bottom line. So with this refinancing, as we can forecast here, we can see that their net income margin will expand by 1 or 2%, which is favorable for a buy. And for the second question, I'm sorry, can you repeat this?
Yeah, sure. So if, let's say, hypothetically, they were not able to refinance the debt at favorable terms, how will that affect your recommendation? What's the sensitivity of your recommendation to that particular thing happening?
As for our valuation, we take the free cash flow to firm approach, so we don't factor in this debt refinancing. Rather, this is just a supplemental reason to buy into the company, rather than just judging the firm's value, if that answers your question.
Maybe to add a little bit more color. So if we're talking about, let's say, their operating margin, for example, which I think is what you're pointing at. So obviously if they weren't able to refinance the debt, we still think there's upside on operating margins from the restructuring plan, but to maybe look at like what the interest expense, how that affects the company's financials. We do see that the company has a positive times earned interest ratio, so we still think that even if the rate was to stay up.
Guys.
Thank you.
Thanks, guys.
Thank you.